Welcome back, everybody. So this afternoon's lecture is going to be on the gold and silver bases. Now, before we get to the concept of the bases, we should just cover what we've gone through already. And it wasn't sort of all in vain, the previous lecture. It was needed as a prerequisite to this lecture. So we'll quickly recap what was said in my first lecture. Now, you all have this at the back of your lecture notes. Fekete research, the gold and silver bases. There are a series of 9 statements there. So I'll be going through these 9 statements and sort of elaborating on them as we go along. Okay. So again, and it's not exclusive to non-New Austrians, we even say it here, we have to make the formal distinction between money and credit. Okay? The only thing that is money is a gold coin or a silver coin, nothing else. Dr. Bernanke does not print money, okay? He prints credit. Okay, so what we went through in the previous lecture, we said, okay, money was gold, and you have all of these obligations in gold terms on gold, and you can rank them according to how quickly they turn or how quickly they mature. So money is gold here, and we coined the term credit. A real bill is still a form of credit, but it's as close to money as you can get. So this was the set of financial assets that expired, bonds or bills that expire in less than 3 months. This was the set of financial assets that expired greater than 3 months from now, but less than a year. And these are instruments that expire over a year, but less than 2 years, etc., etc. So, which set turns into gold more quickly? Which set, apart from gold itself, it's obviously always gold, which set of these turns into gold most quickly?
Real bill. No, back one.
Yeah,
short.
Yeah, the small, and the longest, it's up here. Okay, so that's all clear. This moves very quickly, this moves less quickly, this moves slowly, and the things up here, you can say equity almost is sort of up here, moves very, very slowly. Okay? Now, this cannot be created. This doesn't make sense unless you have a unit of account that's gold. Everything in these buckets is denominated in terms of gold. You yank the gold away, this doesn't mean anything. There's no unit of account, there's nothing. Okay? So this is a classical gold standard with real bills, etc., etc. And as I showed back then, a bank is just a particular sort of cross-section of that. If you picked up a bank's books, it will look like a cross-section of that. Okay? And then we moved on to the concept of the interest rate spread. Again, I'm talking about a classical gold standard with bills and real gold. and you have the interest rate, the gold interest rate, which has a lower bid price. Let's say it's 4.25. There are other people waiting down here. That's 4.5. Let's make that 4.75. 5, 6. And then you have the interest rate offered, or asked, if you're not British. And say that is 5. And then again, there are other people up here, etc., etc. So this was the interest rate bid-offer spread. Bid, offer. Does anyone remember what the offer price was dictated by? The offered interest rate price? It's determined by the marginal entrepreneur via the marginal productivity of capital. And the bid rate was formed by marginal time preference. Okay? So this is what would happen, you know. This would get, I've made a mistake here. Sorry, this should actually be decreasing. 4.5 for 3.53. Okay, so what happens is that the bid interest rate is pushed lower until the reluctance of the person to swap present good gold for future goods becomes apparent, and that presents the bid price. The interest rate offered is pushed up by the entrepreneur. It's pushed up to a level whereby the reluctance of the marginal entrepreneur to commit capital becomes apparent, and that presents the offer price of interest. And as Professor went through earlier, this is just a seesaw with the bond price. But I like to talk in terms of interest rates, not in terms of bond prices. So this is all clear and quite easy to understand. We went through it earlier today. Okay. So point 2, the movement of gold represents the extinguishment of credit without exception. And that credit would have been granted either for clearing or non-clearing purposes. So either from the social circulating capital or from savings. There is no limit to the volume of credit that can be extinguished from a given amount of gold. And obviously that makes sense, because remember, this thing is moving, it's rotating. Okay? So get the concept of movement firmly fixed in your heads. Okay? That credit is related to the movement of gold, not to the amount of gold per se.
The velocity of movement.
Velocity of movement. Wow.
So what we mean is that when gold can clear a practically unlimited amount of credit means provided the velocity is high enough.
Let's think about the platinum futures market under a classical gold standard. Now, obviously, this has never actually existed, you know. We were never on a classical gold standard to begin with. And when we were on a sort of debased version of it, there wasn't per se a platinum futures market. So this is a purely constructed example. Okay, so we talk about the concept of carry. Carry. And carry is basically carrying is something basically something that the warehouseman does. So we're talking about a platinum warehouseman here. A platinum warehouseman will buy cash platinum, spot platinum, in exchange for gold, and will sell futures against it. So let's say he buys 10,000 ounces of platinum. And sells 100 ounce future contracts. Okay, so let's say he buys cash platinum at 1,000 at 1,500 gold dollars and sells a 3-month future for $1,550. Okay. So he's bought platinum at 1,500 and will be able to sell it for 1,550. So his gross profit is $50, isn't it?
Sandeep, you have to take the cost of buying also.
The sale is 3 months later than the purchase. Okay, the gross profit is not $50. Sorry, the net profit is not $50. The net profit is not $50 because you've got a cost of funding involved, which is an alternate use for your capital. No, the net profit will be $50. Sorry.
Gross.
Gross profit. Sorry, gross profit. Yes. Gross profit is $50.
And deduct cost of
Now-
funding out of it.
Yeah, okay. So what do you need to do in order to hold platinum for 3 months? If you want to do this as a business, you need to be able to warehouse it for 3 months. And so obviously you have warehousing costs involved in there. ... Net profit is, let's say, $35. Okay. And it seems like a pretty good business to be in. There's not much risk in buying cash platinum and selling futures. And earning, it's a low rate of return, but it's a pretty risk-free rate of return as well. So buys platinum, sells the future.
Sandeep, how do we determine it's a low return and not a high return? How do you determine in isolation that it's a low? Because I can...
Okay, yeah. Okay. What I'm saying is it's not a particularly risky activity, that's all. You obviously have to compare it to the returns on other things.
Interest is a cost.
I was about to... Okay. So it turns out that... Is there any limit? What if the price of platinum futures went to 1,600? Okay, as long as there were sufficiently empty warehouses, and the price of cash platinum stayed at 1,500. Let's say platinum futures rose to $2,000 for some reason, and the state of warehouses, platinum warehouses, is non-empty. Partially non-empty, so that there is room to store more platinum. Okay? Well, what will happen is that warehousemen will rush in, bid up cash platinum, and start selling the platinum future until it gets down, gets lower, and lower, until it reaches the marginal cost of their capital, which will be more or less the bid rate on interest, plus or minus. Okay? So, assuming warehouses are sufficiently abundant and you've got room to store any amount of the commodity, this will always be the case. There will be a link between the cash price and the futures price, and it will be ceteris paribus, determined by the rate of interest.
Sandeep, you can still lose on this transaction.
How?
the price goes to $2,000. You have to pay market to exchange on futures position.
Yeah, but then you get it back when you deliver.
There's an interest on that futures position.
Yeah. Yeah.
So
Ritesh is making the point that if you bought platinum at 1500 and sold it at 1550, and then the spread went to, let's say, 100, okay, yes, that warehouseman would have made a mistake, but it's only a lost opportunity. It's not a bankruptcy type of mistake.
It can be bankruptcy.
Well, it can be in the sense of if you actually have to put up margin on the short futures contract.
That you have to do it. If you are running a futures position, you have
Yeah.
to have a
No, but
market.
the warehouseman will not have to do it.
Okay.
You know.
Okay.
He has to lodge his platinum at one of the registered exchanges, you know, but, or he won't have to do it to the same degree as someone who's just short the platinum future outright. Okay, so basically, all I'm trying to say here in this particular example of platinum is that the futures price of platinum is very directly related, ceteris paribus, to the rate of interest, to the rate of gold interest. But there is something different about platinum compared to something like wheat. Okay? You can buy cash wheat and you can sell wheat futures, and you can buy cash platinum and sell platinum futures. But the fundamental difference between the two is that there are people who are willing to borrow and lend platinum. There's a platinum leasing market. Okay? Can you borrow and lend wheat? Or do people wish to borrow and lend cash wheat? No. Do people borrow and lend apples? No. Okay? So, do people borrow and lend stocks? Yes, they do, actually, obviously. But the set of things which people want to borrow out of the set of total things is very small. Okay, so the total set of things which could have a futures market attached to them is, let's say, like this. So here you would have, let's say, wheat, oil, corn, VIX, that's the volatility index. And the subset of the things which can have a futures market attached to them, which are lendable, or there is a lending and leasing market in it, is much smaller. Much, much smaller. Can anyone think of anything else? Can anyone think of anything else apart from platinum that might be in here?
It's only perishable things. If it is perishable, it cannot be lent. If it is non-perishable, it can be lent.
Oil is non-perishable. But there's no lending market
The
for it.
tankers are lent.
Huh?
The tankers are lent.
Tankers might be lent. I mean, but oil itself, there is no borrow and there's no leasing market for oil. Okay, the kind of things which are in here are very restricted. They would be things like copper, palladium, platinum. Well, no, gold is the money. Obviously, gold is a special case. Remember, this is under a classical gold standard here. Okay, copper, platinum, palladium, nickel, silver. Well, that subset looks bigger than the other set, but it's not. Okay? So there are certain things for which there is a leasing market. Right. So if there is a leasing market for platinum, what will the carry? Will the carry solely incorporate the rate of gold interest? What other thing must you consider?
Insurance?
No, the platinum leasing rate. Because in the interim between the purchase of the gold and the delivery of the platinum, there is an alternative use for the platinum, which means that the warehouseman can get an income. Okay, so the platinum warehouseman, let's say he didn't realize there was a leasing market, be a bit strange, but and then he acknowledges the existence of the leasing market, and he thinks, excellent, great. Okay, so I buy spot and sell okay. So he's got this platinum on his hands for 3 months. And he thinks, okay, well, I only need to deliver it then. I could actually lend it out. I can lend my platinum out in the interim and earn an extra income. I'm going to lend it out for as close as I can get to that date. So let's say 2.9 months. So he lends platinum out for 2.9 months. Let's say this is the warehouse. Goes off. Okay, goes off. Someone borrows the platinum. The person who's borrowed the platinum has some use for it for whatever reason. Might be a producer of platinum who needs to hedge their production. But it goes out of the warehouse. And then the auditor comes in to the warehouseman's warehouse and he says, show me your books and show me your warehouse. And he says, okay, this is my book. This is my book. I'm short these platinum futures here. And I've got a lease, a platinum lease as well. So the liability will be the future, but the asset on the other side will be a platinum lease, which will turn into platinum in 2.9 months' time, in time for him to deliver it to the exchange. But the warehouse looks empty. The warehouse looks empty. This is an exchange-traded product. So I can see that on the exchange and all of the outstanding contracts there. But platinum leasing is an over-the-counter thing. It's an over-the-counter business. There is no exchange-traded price for the platinum lease rate that you can observe. So to the superficial, that will look like there are many more short futures outstanding than there is platinum in platinum warehouses. And an idiot will say, well, that must mean the futures market must implode at some point. There are some companies who've made a big business from this kind of error, by the way. This error of judgment about how futures markets operate. But it's legitimate, it's perfectly fine. The warehouse will be empty until 2.9 months, where the platinum will return in time for delivery at the exchange. So is that all clear? In this particular example, the platinum the platinum warehouse, because there is the existence of a lending market for platinum, will actually look as empty as possible until it doesn't need to look, until it needs to be fuller for delivery. So is that clear? You pick up all of the platinum warehouses and they're empty, or there's only 1 ounce of platinum, but there are 100 ounces of platinum futures outstanding. There's nothing wrong in